Oh man, has it been a long time. Ah, did you miss me? No, I'm kidding. This is a serious videos. Today, we're gonna have a real conversation about, since we are kind of in a softer market, bear market, kind of for the foreseeable future right now. Could last a month, could last 6 months or a year, we don't know. I think it's a great time to go over the concept of the Timmy options, something that I really spent a lot of time analyzing in my own head, and explain kind of the fallacies of how normal people view money and gambling and risk and reward and things that seem like easy money or a shoo-in. It's a shoo-in. What could possibly go wrong? Those kind of conversations. We're going to go into all of that today. And so the structure of this video is going to be based on Timmy options, which is going to touch on, similar to this culture of Wall Street bets and the whole GMEs, AMCs, and diamond hands and rocket emojis and all these fun things, and the actual options trading, the basic puts and calls, where people place bets in the stock market, whether they think the stock's going to go up or the stock's going to go down. Very simple things. We're not going to get into complex options or anything like that. Just basically people who buy a call or a put option that has an expiration date, and if it doesn't do a certain thing within that time period and hit a certain price, they go to zero. Or if they're right, they multiply their winnings. That principle, and then we're going to roll that principle into the concept of what's happening with collectibles and the fallacies in both of these categories, and really what the true purpose is of options on Wall Street, and pretty much viewing collectibles and the correct perspective of what you can expect to make or lose. So, I know I sound like Charlie Brown. I'm womp, womp, womp. So here we go. We got the real 1984 visor on. So you guys know this is a serious video. I know. For those of you in the comment section, the video starts at 2 minutes because I put the visor on. So, first things first. Let's start with the collectible conversation. The most common thing that people get who are new to the market is, Rudy, is there any opportunity right now? What item should I buy? Or, Rudy, the other side of the coin, I've bought Kaldheim, or I'm on Kitty Cat big boxes and I'm up a lot of money. Should I go ahead and sell and walk away? People always want to know when to strike and when to run, okay? And I tell everyone the same thing. There is no answer to that question. That is an unsolvable equation, because the only way to solve that equation is to have data from the future. And the fact that my DeLorean still doesn't work, no matter how much we hit 88 miles an hour and all this crap, and we don't have roads, and I don't have the data from the future, therefore you cannot solve the equation of when's the perfect time to buy and sell. But it's all about market, it's all about capturing chunks, market capture. That's where people get confused. Because I see people in the comments saying, oh God, look at Rudy over here saying, this $500 box could go down to 400 or 300. That's like a 40% loss if it goes from 5 to 300. This is terrible. Well, okay, but would you rather that, or would you rather buy a $200 item that drops to 100? There's a lot of perspective, a lot of price memory. It gets very, very tricky. On the surface, all this stuff seems very primitive, very just randomized, and the more you get into it and the more you dig and the more you're really willing to learn about this stuff, things are very complicated. So, when you look to buy something, I always say the purchase price and your entrance or your cost base is always the most difficult decision you have to make. When to sell really isn't as difficult of a decision, but when to jump in or go in, a little giggity in the video, but that's the real challenge of when to actually get in. Because when you sell, you have to kind of ask yourself, why are you selling? What are you going to do with the proceeds of the sale? What implications for maybe taxes or extra cash that now gets 0%? You have to factor in the variables based on your situation, your location, whatever it may be. So for example, I'm going to start off this video with someone like me. So when I say, okay, let's a good example here. Box of Revised. Let's pick on Revised. So let's say a box of Revised is currently on eBay for $15,000. Okay, so $15,000. Okay, that's a pretty good sized number. It's still a pretty good sized number, US dollars. And let's say I paid on, I started buying Revised boxes back in 04, 05, 06, and I was paying $600 to $700 a box. Okay, so let's pretend for a second that my cost basis on this box Revised is $1,000. Okay, So that's going to give me a net gain of 14K, okay? So now you have to decide, number one, what kind of tax implications are you going to have? And that question is going to be different based on who you are. You have a business? Are you a sole proprietor? Is it a side hustle, just under a collectible tax? That's something you have to speak with someone who's licensed and legal and all that fun stuff. Remember, this is a video from a guy in a basement who's completely unemployed and doesn't even know what he's talking about. So if you really want legal information, as always, folks, you need to speak with a real advisor, not a guy who wears a 1980s visor and talks about cardboard and draws Styx figures with funny hats on them. Yes, folks, don't forget to look at my tiny hat up there. It's a tiny hat! It's okay. So you have to determine that. Now, for people who have assets, and for people who aren't concerned about income because they're basic core components of their life, overhead, food, shelter, family, everything's taken care of. That's actually when things get very complicated. Because now, I see this 14 grand and I say to myself, okay, let's pretend this is after taxes and let's just keep the taxes because, again, every state, location, individual is different. So now you got 14,000, okay? Well, the problem is not the profit. The problem is, where do you go from here? So A, you leave the money in cash, it gets 0%, okay? That's awful. B, you roll it into another collectible and you try to make a gain. So another box, okay? So you're gonna roll it from one box to another box of cards. C, you move it over and you're going to, let's try, you want to go into Wall Street and buy a stock or an equity. Let's just put stock to keep it simple in the video. Okay, let's say you want to do real estate, okay? Okay, let's say crypto, okay? I was going to put like BTC or Bitcoin, but I know Bitcoin does not represent the whole crypto universe, and I know people are trying to, decouple that, so that's a sensitive conversation. Or, of course, at the end of the day, maybe a bond or a CD, which pays 2%. Let's say, I don't know, something terrible. So now the question for wealthier individuals is after they make this money and they lock in the profit and they walk away, it gets complicated because to people who have assets, cash is trash. They don't want cash. Cash represents virtual employees. Wealthy people want the money to get up in the morning and go to work for the owner of the money. So letting this sit at 0 is an awful idea. Why on earth would you take it out of this magic rare revised booster box that's been gaining value like crazy over all the years, but and you're just going to put it at 0? What's the point? So immediately that's no good. Okay, so you're going to go to exchange to another box? So the purpose of that is, I guess you're telling me, based on your actions, that this next box is going to outperform the previous box in the next 5 to 10 years. How do you know that? We already talked about in the beginning of this video, you cannot solve that equation, and you cannot confirm that it's a good idea. You can't go from a revised box and say, Rudy, I'm putting Modern Horizons 2. It's going to go to the moon just like revised. That's speculation. We don't know if that equation will be true until the future unfolds, and we can't solve that. Okay? So that is, all you're doing is rolling one category of box because you feel like you're locking in profit. But if you roll it over to 50 boxes of Modern Horizons, you're really keeping in the same category. And the nasty truth is, these two things, a revised box and a Modern Horizons 2 box, they're overall going to perform in similar percentage gains over a 10 to 20 year period, keeping them sealed, no single card discussion, as the overall market. It's kind of like they always say, people who handpick stocks tend to not outperform the S&P in the long run. In other words, you can try to handpick which box of cards is going to outperform, but you're probably going to be wrong, or you're probably going to be jumping back and forth. It's like people trying to, move their Bitcoin to Ethereum, move their Ethereum to Cardano, then move their Cardano to doggy coins, go back to... You're trying to time the market. And we all know, timing the market, you're always going to lose against the people who just beat you with more time in the market. And we've discussed that in another video. So, that's still not very attractive. Why are you getting rid of an old rare box to move it into something that's cheaper, but percentage-wise, you're not going to come out ahead. And you're incurring transaction costs, probably taxable events, incurring additional risk by moving assets, finding buyers. There's a lot of layers of risk there, okay? So you can see where this is going right now. Seriously, everybody. So next, on part 2 here, after we realize that, in part 2, we talk about now, okay, I guess maybe stocks. Maybe the stock market crashed. Maybe you're saying, I'm going to lock this in at a record high price revised. Stocks are down 40%. I get it. You're selling at a high, and you're trying to jump in at a low to amplify gains. I get it. And then the other option is real estate. Again, historically, post-2020, all of these categories are going up pretty in sync. As they say, the beta coefficient, in other words, how much these correlate with each other, tends to be pretty close to 1-to-1. So there's not really a lot of opportunity for arbitrage moving between categories, and you're incurring taxable events, transaction costs. You could be incurring buyer risk and different counterparty risk. So you're not really there. Remember, rich people focus on downside. Timmy's focus on upside. All Timmy cares is for that $1 lottery ticket, I can make $100 million. A wealthy individual says, wait. That $1 lottery ticket has an expected value of almost zero. That's the issue. They're looking at the probability of events, not the upside. They're looking at downside, the probability of a downside, and etc. So that leaves us with crypto or something safe for 2%. In other words, I'm sure you're starting to realize, it's not always the best thing for a wealthier individual to lock in profits even when they're up a lot. That's why you see a lot of circumstances and situations where individual people have crazy positions in collectibles, Pokemon, magic cards, flesh and blood, whatever the category may be, and they're simply just not selling, or diamond handsing it. They just, whatever lingo you want to use, in their point of view, it's just not attractive because they're not looking at locking in gains. They're looking at, what do I do after that? They're always 3 steps ahead. And that also buoys the markets of collectibles. It's a very strange thing. So now we're going to jump over. We're going to kind of piggyback on this conversation, and we're going to jump over a little bit, okay? So now we're going to talk about regular options on Wall Street. So when Timmy on Wall Street Bets says, I'm going to put $10,000, okay? And I'm going to buy, a call option on GME, GameStop. Everyone's talking about GameStop. Again, I don't recommend it, but seek a real advisor. But we're going to talk about real. So you're going to put a $10,000 bet that GameStop's going to go to $1,000 a share. Something insane, okay? And you're going to buy that bet with an expiration date. So again, simply put, when you buy a contract, you have a strike price, which will be $1,000 a share, 1K. You have an expiration date, which let's say is 30 days. Okay. And then you have all kinds of more complicated things. We're going to leave out in the video. The Greeks, implied volatility, the theta, the time erosion. We're not going to get into all that stuff. I want to keep it simple for most of my viewers here. Okay. And simply put, if this $10,000 bet, it's literally called a bet, does not, GameStop is, let's say, $200 a share. Okay. This is GME. Okay. So if GME does not break $1,000 a share within 30 days or at the 30 days expiration, your $10,000 goes to zero. Okay. Now the question is, how do you calculate? How do you determine all this stuff? Remember, people say, well, Rudy, the stock can either go up or go down. So it's either you buy a call option for going up or a put to go down. Well, the problem is that people don't factor in is a lot of the stocks can trend sideways and do neither option, because people always say, I always ask them, what can a stock do? And people say, well, Rudy, the stock can go up, right? And I said, yes, it can. Well, Rudy, the stock can go down, right? So this is the only options. I said, technically, there's a third option, which is a consolidation phase. Consolidation phases are actually what destroy most option traders. Actually, not the stock not going in the actual wrong direction, but just a lack of activity or a stalling out. After a huge chart, like the stock will move, and after a big move, and then it levels out. And when it trends sideways after the big move, that's actually where most people lose out. And remember, this whole thing is not about buying here and selling here. If you buy right here and you sell right there, you still captured a good chunk of the market. And that principle is what needs to be applied to collectibles. You will never time it right. And the most dangerous thing about options is that the expected value is either you're right and you hit it big, or you're wrong and it goes to zero. And that is the gambler's fallacy. And the people who engage in very amateur versions of that will brag to you about how they hit one really big and they made thousands. But just like any other gambler who buys scratch-off tickets, lottery tickets, they go to Vegas, they are not going to tell you about how much they're going to lose. They're only going to tell you about the wins to skew the perspective on how you view that individual. That is human psychology. It's been that way since the dawn of time. Casinos and gambling and mafias and all that crazy stuff. Okay, so it's a strange thing, folks. And there is a fine line between investing and gambling. Okay, and many times that line does get blurred, and many times you can't tell the difference. Okay, when I turn around and I put a lot of money in a product, let's say, you know, so for example, let's say I keep a whole pallet of Theros Beyond Death, which is now out of print. Okay, 500 boxes of Theros. Okay, cost basis $80. Okay, you have 500 boxes of Theros. Was it Theros TBD? Theros Beyond Death. Okay, so you have a whole pallet. Here's the pallet. Here's the bottom of the pallet, and here's all the boxes on the pallet. Okay, there you go. See, that's what a pallet looks like. There you go. You guys like my artwork? I think it looks pretty good. So there's a pallet of Theros. Okay, when I buy that pallet of Theros, and I have a cost basis right now of $80, what I'm looking at is the risk reward. Okay, we start off and we off to the races. It's out of print. What's the downside? The downside is essentially next to zero. The worst case scenario is what? The open market is 90 to 100. So what? The market price right now is sitting at what? Let's say 95. Okay. So what is my real risk here? The real risk is probably opportunity cost. You could have moved this money. So what? 80 times 500, what? 30, 40 grand? Right? So let's just say we got 35K tied up in this. Okay. So when you put 35K in an $80, $90 box, the real risk you have, I guess, is opportunity cost. In other words, you could have put that money somewhere else. And I could have, if you had just put that money in the S&P 500, if you bought a house 2 years ago, it would have outperformed. Well, that's great. But it doesn't mean it's going to do it again. So the key is with this stuff is you have to really focus on market capture. When I see a product go out of print, and I have a cost basis of $80, and eBay and TCG Player's $95, that's a gorgeous scenario. It's almost a piece of art. It's so beautiful. Because I'm watching this, and as the supply and the natural attrition takes in, this price is going to move. It's going to move, but it's going to go like this. And then weird things will happen. We'll have a spike. It'll come back. It'll spike. But overall, that direction is very safe. Safe. The risk, the teeter-totter of danger, is not either a $10,000 bet on GME, and that 10,000 goes to $1 million, or the 10,000 goes to zero. This 35 grand really has almost zero downside potential. There's nothing. Because of the worst case scenario, you know how easy it is to unload an out of print product at $80 a box? See my point? But the upside is eventually there will be, here, this is interesting right here. This is fascinating, guys. So the upside is there's going to be moments right here. See this? And right here, and right here. There's going to be market repricing moments. And those are the moments where the people who are in the market always win against the people timing the market. Because when you time the market, you can't predict the giant pops, the repricing that happens. All of a sudden you wake up one day and Theros went from 95 and all of a sudden Theros is 150. And you're going, whoa, wait, whoa, what happened? And you have that moment. We've all been there. We've all experienced that moment. And it happens over and over and over again. So essentially what's going on is you have to really look at market capture in the movement of this stuff. And, I'm going to go to Modern Horizons 2 because I know everyone's going to ask me about that. We'll do a whole thing with that next. So, in the odds of trying to time the market, you're going to miss out on these giant gains. And yes, after it pops heavily, you tend to have, where's my red marker? Hold on. You tend to have a retracement. See the retracement? See those retracement periods? And that's normal. That's healthy. You always say, oh, look, it's coming off the high, and oh, the easy money's been made. And that's always my favorite. The easy money's been made. And in the big picture, it doesn't matter. Because even if you buy right here, even if you miss the first pop, and you start buying Theros Beyond Death boxes right here, came off the high of 150, comes down, even you start buying at 130. Eventually, when you wait long enough, there will be another triggered event, whether it's a card in the set. Nope, sorry about that. Another card in the set, part 3, sorry about that. Something else is going to cause a future trigger. It doesn't make a difference. There's always going to be something. And that's the thing is, you always see people go, I missed out at buying at 80, 90 a box. It's 150, then it comes back to 130. When you have those moments where it consolidates and even retraces a little, even at 130, it would still be a good technical price point and cost basis for the long term. It still is a good opportunity. But most people will not take that because all they have is price memory of $80, $90 a box. The easy money's been made, blah, blah, blah. And people tend to make the wrong decision. Okay? And that's the funny thing. So when I look at options in trying to capture something or trying to lock in profit, you really gotta have the right perspective of everything. And by the way, this time frame here could be 2, 3, 4, 5 years. We don't know. Every product and every palette performs completely different. Sometimes this entire window from 80 to 300 could be a year. Sometimes, Time Spiral Remastered. Other times, this window could be literally 5 years. It's different for every product, but you can't let the rate of speed, the velocity of change, cannot discourage you, Because it doesn't matter. In the long game, it doesn't matter. Like our example with the revised box. I remember revised booster boxes, when I first started buying them at $600, $700, people, they were just sitting stock. Literally, I remember there was nobody else buying or bidding against me. It was ridiculous. And then when they went to $2,000 a box, I remember people thinking, oh my God, why would you pay $2,000 for a revised box? All you get is a couple dual lands in the box. Nothing else has value. Right? Sound familiar? And then revised boxes went to $4,000. $4,000 went to $6,000, to 8, then to 10, then to 12, then 15, then 20, then 22, 23, then back down to 18, back to 15. Along the way you have the ebbs and flows, but it doesn't matter. People who focus on these short-term things, it drives you crazy. So, let's talk about Modern Horizons, I guess Modern Horizons 2. Let's talk about the new one. I think that'd be a good time to really, let's pinpoint that. Let's get our, let's use the blue marker. And let's really talk about this new mod. I think this is a good point here. So when Modern Horizons 2, let's say the draft boxes, right, or the set boxes will probably be most available. So let's say set boxes, and let's just use an even number of $250 with taxes and shipping and fee. Let's make an even. So right now, Modern Horizons 2, the set boxes, $250, okay? Now, the question is, you have a lot of variables. Are we going to immediately see, I believe the chart and the price is going to be like this. I think Modern Horizons 2, which actually it's already come down. It was like a 3, and then you had these drops. We're at 250. I think we could have these weird short-term moves. Then we have that erosion period where nothing happens, and then you have an event. I think the chart is going to unfold something weird like this, where we had the pre-release before the product came out. It was like 300, okay, and then it came out, and then it would start. People realize how good it was. Here, hold on. People realize how good it was. Then you have an uptick. And then all of a sudden, Amazon has endless supply. We have a downtick. You see what I'm getting at here? So when you look at this time frame and you follow this stuff, and then eventually Amazon has more. Drops even further. 230. Oh, Amazon ran out. Oh my God, it ran out. Amazon ran out, folks. We're back up. 260 now. Look at this. You can't predict this. It's completely insane. And people trying to time every penny and every dollar to get this stuff perfect, it's a losing battle. And there's no point in it. Why are you stressing, and why are you trying to figure out an unpredictable graph? Because if you really take something like this, here, let's take this random eBay box, and you literally take this, and you look at the chart when it's only at 300, and then it moves, you have no idea that it's going to go straight down. You have no idea we're going to drop again. You have no idea. Then all of a sudden, holy crap, it's going up. What changed? What happened? And then wait, nope, it's going back down. Wait, all of a sudden, nope, nothing's happening. It just keeps dropping slowly every day. You see what I'm saying? When you don't know what the future of the chart is, it makes it a lot more weird. And then, of course, eventually, something changes. It goes out of print. You have the market ages. And then in the long run, this graph continues to just go way, way higher. And let's say, which I do think will happen, I guess we can leave that for a second. So let's say now, the supply problem is not a problem because Amazon always has it. And let's say now that, Modern Horizons 2 goes out of print in 15 to 18 months from now. And that means in 3 years from now, out of print plus another year or two, the box prices are, let's say, 5 years from now, which is 3 years out of print, let's say box prices are $500. Okay, so if box prices are $500, okay, does it really matter all the stress and everything you went through of the Timmy thing and people returning and trying to time this and Amazon this and that every day? You know, there's a fine line in this world, folks, of spending too much time analyzing and stressing about specific small price swings versus a lot of larger investors or hedge funds or these Warren Buffett, Jimmy Buffetts, and these people who have so much positions, they don't even look at the market noise. Because when I see this right here, this whole area, all of this, that's market noise. Because 5 years from now, when it's way up here, no one's going to remember any of this. No one's going to remember it. Because it doesn't matter. And that's the difference between people who are really short-term, very emotionally driven, versus people who've done this stuff a very long time. Because there's a lot of people in this industry, you know, including myself, you know, 10, 15, 20 years of doing this stuff. We've seen so many products come and go that you become desensitized. You get almost diluted. You just get so comfortably numb to the movements, it just kind of makes you go, eh. So I thought that was important. So to swing it back to the people doing options trading on like Wall Street Bets and Robinhood and all the other brokers. I really shouldn't say Robinhood. You could do options trading on any brokerage firm. You could be Vanguard, E-Trade, TD, Ameritrade. You could use Schwab. You could use any mobile. It doesn't really matter. Anything. I guess Robinhood is just notorious because they're in the media now with all the option stuff. It really doesn't matter. Any brokerage firm. You can't blame a particular firm. You know, options were not... You know, I'll cut the video off here pretty soon, folks. I think the video is getting pretty long. Options were not invented for people to bet in the stock market. Okay? I want you all to understand something. The same way a sealed booster box was not invented to be a mutual fund style investment of the cards within the box long term. Options on Wall Street were not invented for gambling and betting. These derivative products, options are called derivatives because they derive their value from an underlying security. Whether it's a stock, a bond, an ETF, a mutual fund, you know, some collateralized piece of paper, commercial paper, a mortgage back, options are derivatives. These derivatives were designed and engineered because there was a market and there was actually professional institutional buyers that needed methods of hedging and methods of exposure, of increasing exposure and reducing exposure. So at the end of this video, for example, I'll give you a personal example here. So let me give you a good one here. So let's pick on something silly here. All right, I guess we'll just, since we're talking about magic cards, we'll pick on Hasbro. Obviously, I've disclosed I do have, a couple hundred shares of just Hasbro. So for example, let's pretend I had 1 million shares of Hasbro, okay? Hasbro stock, let's say today, is $95 a share, okay? Institutional investors many times will take options and they will sell covered calls. They will sell the contracts to other Timmys. And they will set the strike price way out of the money. So in other words, they will sell contracts on Hasbro for like $120 with a strike price with 12-month expiration, and they'll collect a fat check the moment they execute that. They will take some of those proceeds and they will purchase downside put protection. They will downsize put protection, also known as PP. You guys like my terrible handwriting? Pretty nice. So they will use, let's say, half of that proceeds to actually hedge the downside, kind of put a safety net, a little net under there. They'll put a safety net to reduce their downside exposure to their clients. Okay? You guys understand what I'm getting at here? Does that kind of make sense? Anyways, but we'll wrap the video up here. Final part of the video. But that's the purpose of options, is for more complex trades and not for just throwing money and betting that something's going to go up. Most contracts in options and derivatives trading are done by professionals to increase and reduce exposure in different asset classes. And, the collectible world is very similar. It's very similar. If you are, there was a thing a long time ago, and I know we're getting to the end of the philosophical conversation today. The joke in the collectible world was you always wanted to open an LGS in the 90s and be a part of the collectible card world, because anyone who served 20 years as owning an LGS with a distributor and a brick and mortar, after 20 years, your 401k and your retirement account would be all the leftover inventory of all the products that you were part of the releases over a 20-year period, and all of that would appreciate so much you would have millions, and that would be your retirement account. That was the joke in the industry for many years until recently. How do I say this? That was the mindset originally designed. Like, when you deal with options on Wall Street, you're gambling by risking everything where you're not going to have a retirement in the future. You can't take on that much risk. Like I said, in the LGS world, if you launched the new Magic Modern Horizons 1 set a couple years ago, and you kept the last couple cases, you made money, paid your bills, you kept some inventory. Then, you did all the other sets. Now Modern Horizons 2 comes out. You sell everything, do your thing, pay your overhead and bills, distributors, shipping, chargebacks, mean people, deal with it all. You keep a couple cases. And all these products would age very well long term. That was the original intention and the original kind of meme of owning an LGS. Okay? But it's really lost its way. Most stores and card stores around the country and the world now, they barely make it. They're undercapitalized. They're barely making it. There is no... And I know the public and everyone always just talks about how there's so much inventory out there, and there's thousands of Rudy patrons just sitting on warehouses of product, and there's this I don't know where it comes from, just made up acceptance that even in the last 5 years since I've been on YouTube, everybody's just keeping sealed product and all this, and it's still nothing has changed. And that's the funny thing about humans in human behavior and psychology. The more things change, the more they're always the same. Nothing has changed from 5 years ago to 2021. The products are different. The prices of the items are different. Hasbro stock is this price, but everything's relative. And that gets into the conversation of old Magic and buying a really expensive stock. Again, let's say you're buying some super expensive Amazonian rainforest stock. That's $3,000 a share. And people say, why would you buy Amazonian stock when it's $3,000 a share? That's crazy. The easy money's been made. Well, probably not. That stock can probably go to 5 to 10,000. Whether they split the stock or not, who knows? And it's the same principle as someone buying today a box of Revised for 15,000. You don't think a box of Revised can go to 20, 30, 40,000? I do. But the number's so big it scares people because the brain doesn't want to accept it because it makes you nervous. And it's a really funky thing. And that's the same principle of why people today still think, oh, the new product today, it's all printed to oblivion, it's all this and that. The amount of people who have knowledge of this collectibles or Magic or Pokemon or whatever it is, there's a lot of people out there that have this knowledge and love the collectible world. But there's very few people who act on it and then stay the course, no matter which way the wind blows. And that's the difference. And that's why nothing's changed. 5 years ago, people were bashing me when I was telling people to hold and sit on sealed boxes of Eldritch Moon and Shadows of Innistrad and Battle for Zendikar. Are you serious? Those were printed to oblivion. Every Battle of the Zendikar had millions of boxes. Same thing. Oath of the Gatewatch, Kaladesh, Amon Kitty Cat, Ixalons. And they all go up. Because people don't believe in it. They always believe the easy money's been made and it's already over with. And that mentality can be applied to crypto. Oh, Bitcoin's 30,000. It already tanked from 60. But I'm not buying unless it goes back to like $2-3 grand. I mean, I missed out. People say the same thing about real estate. That house is $1 million? That house used to be 100 grand in the 80s. Okay, well, I mean, you can wait 10 more years. Maybe there's a dip and maybe that $1 million house goes to 800,000. But if it doesn't, you're really hosed. There's a way to argue. But like I've told you all, the biggest risk of all this stuff is the risk of not being a part of it. The risk of not being in the game. The risk of not being in the market is the greatest risk of all. And that's something that regular people, and I hate to say regular people, but I mean like working class, and they just kind of watch YouTube at night, maybe buy a box here and there. There's so much opportunity. And now we're in this era of inflation. And unless you have exposure to assets that as inflation flares up, your assets flare up with it. So you are essentially hedged. Regular working class individuals and lower income individuals are going to continue to get obliterated. And that's a terrible thing. That's a really shitty thing. Because I believe everybody should have an opportunity to invest and build wealth for themselves and their family. Because it's a good thing. It helps you move it on. It helps build it. It makes your son or daughter have a better life and all that generational conversation. But it takes a lot of time. It's a grind, and there's no shortcuts. And in 2021, and all these people became millionaires from doggy coins and GMEs, our perception of everything has never been more distorted. It is more distorted now than any time I've ever seen in history. And we are all in a process right now of coming down from these big highs. We're all high on our own supply. And we're all coming back to earth from our rocket emojis of that. Guess what? 5 to 8% was what the actual return should be. Double digit 10, 15% is unreal. But these 50, 100, 200% returns, this was never meant to be that way. So we all need to continue to resume getting back to normal. And guess what? Anytime you come off a high, it's going to be painful. It's going to suck, and it makes you want to quit. And again, like I've told you all, it's going to flush out a lot of people. And I think we are building the framework with these new sets and higher prices for the people who are going to be involved. They're going to do very well in the next 5 years. But it's going to be a bumpy ride, and most people are going to quit. I don't know if anyone really watched this long video, but if you did, I don't know, give me something silly. Give me a hashtag, Resident Evil. I don't know. Have a great day, everybody. Hope you guys learned something.